I've loved gold. I still love gold, the gold mining stocks as well, but physical gold. I would also say silver, playing some catch up, although it has more industrial characteristics. But I like the precious metals. I think the US dollar has entered into a bear market. I'm not saying that the US is going to lose its reserve currency status, but I do think that the US dollar has certainly been tarnished. I find it to be I started turning bullish on gold back in 1999, and this is probably within the next 5 years, we believe, because gold is following its historical pattern in a bull market, which means what? It means in this bull market, the peak will be somewhere close to $6,000 an ounce.
Recent evolutions in U.S. attitudes and policies have raised questions about the future of the dollar's role in the global economy. Reserve accumulation hasn't driven the financing of the U.S. current account deficit in recent years. We are now in the early stages of a period filled with uncertainty and chaos, and it will continue, says David Rosenberg. He warns that the U.S. dollar might lose its status as the world's reserve currency. Despite shrinking imports and Trump's tariffs in April, dubbed Liberation Day, the U.S. dollar has still weakened by around 7% this year. The U.S. share of a leading global equity index is now around 70%. That is significantly above the dollar's share of international reserves, now around 58%. All these numbers raise questions about the widely held notion that the bid for dollars in recent years is somehow tied to the dollar's status as the world's leading reserve currency. Amid escalating global tensions and a concerted shift away from reliance on the U.S. dollar, central banks are increasingly turning to gold as a strategic reserve asset. According to the recent report, Annual Gold Market Outlook sent, local banks are expected to purchase 1,000 metric tons of gold in 2025, marking the fourth consecutive year of significant official sector buying. Although this forecast represents an 8% decrease from the record 1,086 tons acquired in 2024, it indicates that central bank demand remains historically elevated. When it comes to gold, Rosenberg is very bullish. He first became bullish on gold in 1999, when European central banks stopped dumping it into the market. Based on his team's research, he believes gold could reach as high as $6,000 an ounce within the next 5 years. We're about to explore the video, but first, be sure to subscribe and click the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
I mean, you keep hearing about the Mar-a-Lago Accord, and then the Section 899, that the U.S. would dare, as a retaliatory measure, impose a tax on interest and dividends on securities held outside the country. I've got to say this, that Liberation Day was a big day for me. I think Liberation Day liberated us from our sanity. When Donald Trump went in front of the cameras with all these reciprocal tariffs, and every country had a different number. It was like a bingo game. But there was a method to that madness, because those levies reflected, and that's why each country had a different number, because it reflected the ratio of the bilateral trade surplus that country X ran against the United States. That trade surplus divided by its exports, expressed as a percent, and then added on to the 10% baseline tariff. And so what was the message that the president was sending? Was that he wants the bilateral trade surpluses that countries have with the United States to vanish completely, even though it's completely appropriate and normal, and I would say desirable, for the world's reserve currency to be the country that runs trade deficits with the rest of the world. Because being the world's reserve currency means that you attract all this capital inflow. That capital inflow generates wealth, generates spending that gets spent in imports. And no other country in the world has such a low savings rate as the United States. No country in the world has a consumption to GDP ratio of almost 70%. And so what happens is that the capital account and the current account have to balance. It's called the balance of payments. So if Donald Trump wants to shrink the trade surplus, trade deficit that the U.S. has and get it to zero, what happens to the capital account? And what is the message on Liberation Day? The message beneath the message, and I wrote about this, is that what is he signaling? You got to think that this is somebody who's been talking about unfair trade and tariffs since 1987, and now he can do something about it. I think the message was on the middle class in middle America of being the world's reserve currency is just too much. That's the first time that I wrote a report saying that for the first time I'm writing this, that perhaps in my life we will see the end of the US dollar being the reserve currency. We just don't know what's going to pick it up. But remember, it could well end up being the euro. It could end up being the euro. The euro was supposed to be the challenger in 1999, if you remember, on its introduction. But it's hard to make book right now. But I would say that, when you're taking a look at things like CDS spreads, and you're taking a look at, what that hidden message was. That hidden message was that we don't want to run trade deficits anymore. Even though it's completely normal for the United States to be running trade deficits, there's nothing wrong with it. It's actually the role of the reserve currency. Understanding that the balance of payments have to balance. And the message, like I said, is that maybe the world's reserve currency is just too much to bear. And look, this is, I think that Donald Trump will continue to push the envelope. You're asking me, is he moving to reset and reshape balance of trade? 100%. The last president to have done it on this scale was Richard Nixon. Correct? Richard Nixon. And so going off the gold standard. So this is going to be, so I think that we are in the early stages of heightened state of uncertainty, confusion, and chaos. It's not going to go away anytime soon. As far as Donald Trump's concerned, this is all going to be for the greater good. For that, we'll see. As far as gold is concerned, look, gold, how do you value gold? Value trade on gold. They call it digital gold. I say, okay, well, I'll just buy the real thing because, the beauty about gold is that it doesn't have correlations with so many other things. It's such a great non-correlated asset to have in your portfolio. Bitcoin is most correlated with the NASDAQ 100. I don't want to buy gold if it's correlated with the NASDAQ 100. In fact, it's inversely correlated with the risk on trade. That's why you want it in there. It's a ballast in the portfolio. But how do you value gold? How do you do it? You can't do a dividend discount model on it. You can't do, real interest rates, inflation expectations, default risk, recovery rates, term premium. How do you value gold? Gold is basically 1 divided by U, where U is uncertainty. Or I should say 1 divided by C, where C is certainty. That's the quotient. It's perfectly proportional to uncertainty. And I started turning bullish on gold back in 1999. When I was just making that transition from the Bank of Montreal to Merrill, when the central banks starting in Europe announced that moratorium on their gold sale program. That had undermined gold for so many years. So let's not forget, especially those people that watch QE, let's not forget the power of the central banks. And we're talking about all of the central banks globally, not just the BRICS, not just China. There are no central banks globally selling gold. 3/4 of them are buying gold every single month. They are diversifying. That might help explain the downdraft in the US dollar. And the strength in gold. And you don't want to bet against central banks. They have deep pockets, but there definitely is a reallocation and a diversification among central banks back into gold. And I imagine that the day that I hear an end to that program, I'll reconsider the gold. We did all sorts of work on this, all sorts of work on gold. And I would tend to agree with you, up almost 30% 2 years in a row. I think we should expect a pause. That would make sense. Of course, gold's benefiting as well from this downdraft in the US dollar, but be that as it may, the work that we've done, and we published, and this is probably within the next 5 years, we believe, because gold is following its historical pattern in a bull market, which means what? It means in this bull market, the peak will be somewhere close to $6,000 an ounce. So I am not trading around it. I am buy and hold. And if there's dips, I call my dealer and I buy more bullion, or actually what I prefer now are gold coins because they're prettier. But that is actually gold remains probably undeniably my highest conviction trade.
America needs foreign investors, and foreign investors need America. Yet clauses buried in the Republican budget bill in Congress are a threat to this crucial symbiosis. Under the obscure Section 899, the Treasury Secretary will gain the power to tax interest, dividends, and rent flowing to foreigners in countries with tax systems that the law defines as unfair. The rate will start at 5% but could rise as high as 20%. Foreign investors have several reasons to be cautious about U.S. government debt at the moment. The risk of a weaker U.S. dollar and the cost of hedging against that risk are making American assets less attractive globally. That comes at a particularly challenging time for the U.S. Treasury market, which is already contending with a deteriorating U.S. budget outlook and the ongoing trade war. David Rosenberg has long been a strong advocate of gold. He still really likes gold mining stocks too, saying they're cheap compared to where they should be. He's also into silver. Even though it's used more in industry, he still sees it as a good buy. As for the U.S. dollar, He doesn't think it will lose its role as the world's primary currency. Now, let's redirect our attention to a video.
I do like treasuries right now. I can't say I love them, but I like them. Within the stock market, I like what I refer to as bonds and drag. I like the sort of parts of the stock market that are correlated with declining bond yields. And I think the Fed will resume its rate cuts by September. I think we'll have enough clarity at that point. And the clarity will be that with the labor market loosening up, the inflation shock from tariffs are going to hit the wall in the labor market. And so what we'll end up with is a few months of higher inflation prints, but that'll trigger negative real wages, and that will trigger negative real consumer spending, which ends up bringing inflation right back down again. So the way you want to think about this is the price level will be higher, but inflation actually, because of the tariffs, counterintuitively, inflation will probably end up being lower because of the extraction of demand out of the consumer sector coming out of this. This isn't like it was, again, in 2022, 2023, we had a massive mismatch in a hot labor market where companies couldn't find the demand. Everybody was job hopping, and Uncle Sam was paying people not to work for extended periods of time. Remember, the jobless extension benefits were massive. Companies had to pay up. So we actually had a wage price spiral for a period of 18 months. It's not going to happen this time around. It's going to get snuffed out in the labor market. And that, again, came through loud and clear in the beige book. But I like, for example, I like utilities. I have for a long time. They've done great. Consumer staples. And I'd be saying, it could be the drugstores. It could be food producers, food retailers. And I like the fat dividend yield and the dividend growth characteristics, though I guess a lot of people can't own them in their portfolio. But utilities, consumer staples, segments of healthcare. I want to be in areas of the market where there's stability, earning stability. I want things that typically don't hurt you in a recession. Or can help you in a recession. There's one stock I can tell you that the one stock historically that has never hurt you in a recession is Walmart. And I view that as a defensive retailer. So I would say that staples, utilities, healthcare, I want to be in low beta. I want to be very mindful of the beta, very mindful of the cyclicality in the portfolio. I want the dividend yield and I want the dividend payout ratio in areas of the market that don't have a whole lot of correlation with GDP. On top of that, I've loved gold. I still love gold, the gold mining stocks as well, but physical gold. I would also say silver, playing some catch up, although it has more industrial characteristics. But I like the precious metals. I think the US dollar has entered into a bear market. I'm not saying that the US is going to lose its reserve currency status, but I do think that the US dollar has certainly been tarnished. I find it to be a really quite astounding comment that the stock market would be heading back to the highs, and yet the dollar has been sinking. To have an 8%, 9% decline in the dollar from the peak in such short order, that's like over a 20% drop in the stock market when you look at it from a relative risk standpoint. It's been so foreign investors are telling you something, and it's telling you that, because the truth is always in the price. The price of the dollar is telling you that something is being sold in the United States, and there is a reallocation to the rest of the world. So I mentioned utilities. I mentioned segments of healthcare, the more defensive areas of healthcare. I mentioned consumer staples. I like gold, as I said before, and the gold miners still trading at huge discounts.
The relationship between gold and the US dollar is changing. The value of the dollar significantly impacts gold prices. This alters how investors behave and what occurs in the market. The dollar's status as the global reserve currency is facing a challenge. Central banks globally are reassessing their reserve currencies. Many are choosing to hold more gold and other non-dollar assets. This change aims to boost economic resilience and lessen dollar volatility risks. As a result, gold demand is increasing, driving prices up and solidifying gold's status as a safe haven. Could a shift away from the dollar lead to a significant change in global financial power? Join the conversation. Share your thoughts in the comments. Give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.